Hi, I'm Max Keiser. This is the Keiser Report. A lot of people talking about, is this the beginning of China as the world's superpower? But they're not thinking about another end of an era, and that would be the central banks. Stacy.
Yes, we are. We believe here on Keiser Report, anyway, that we are at the end of a fiat era. And we've been kind of warning and preparing for that for the past 10 years of this series, 11 years now. And you could see that even Jerome Powell, sitting head of a central bank, the US central bank, is even saying this. Remember last year, Mark Carney said that as he was exiting the Bank of England, he said that the dollar was no longer fit to be the world's reserve currency and that we need these a digital currency, sort of SDR sort of currency to replace it. And earlier this week, we saw Jerome Powell stated that he would dread a day that digital currencies take over the current fiat system and the US dollar would not be the world's reserve currency anymore.
Right. It's like in history, people dreaded the day that gas lights were no longer around and we went to electric lights. And they dreaded the day that cars took over and we didn't have horse-drawn carriages anymore. And, things change and he can't do anything to stop it, Jerome Powell. He could be the last Fed chairman in the United States before the Bitcoin takeover. And so this is just all part of life.
I think it's more like the day that, the French royal family dreaded the day that democracy and a republic would form rather than, the peasants be happy with brioche. So here he's saying, I hope the peasants remain happy with this Cantillon effect that is a part and parcel of a fiat system whereby we, the central banks, create money and we give it to the oligarchs, the aristocrats of our era. Now, the money first.
Right,
Same thing happened back in the French time.
The strategy, isn't it, is to give the money to a group of folks on Wall Street and then trust that they'll be fair about its distribution. And what we've discovered over the past 50 years is that it started off unfair and it's gotten more unfair over 50 years to the point now where money velocity is at zero and the cantillionaires are growing exponentially.
Yeah, as Simon Dixon pointed out in the last interview, there is a sense that they understand this problem they've caused and they want to start giving money to the people instead. But it's kind of too late because after 20 years of this mass Cantillon effect, that we see, the top 1% have all the wealth and all the assets. So they could buy up everything before the inflation arrives of all this money going to the ordinary people. But, another quote that we say all the time here, and I think it's one of the most relevant to this sort of Cantillon economy that we do have, and that is from Frederick Bastiat, one of the thinkers of the French Enlightenment. And it is relevant to today because we do see a trickle down of the plunder that happens at the top. So when plunder, this is the quote from Frederick Bastiat, becomes a way of life for a group of men in a society, over the course of time, they create for themselves a legal system that authorizes it and a moral code that glorifies it. So that I use in reference to this tweet from Liz Ann Saunders, who says parabolic spike in business applications. Look at that parabolic move in the formation of small businesses that happened. This chart goes back to 2004, and you see the parabolic spike. Why? Well, because you could either, work from home, be unemployed at home during this pandemic and collect $600 extra a week, or you could become a small business and collect $1 million from the taxpayer and become, you're closer to the Cantillon class that way. Right.
The Federal Reserve should not be operating like a multi-level marketing scheme like Amway or Mary Kay Cosmetics, right? That's an established way of doing business where you refer people and those people who you refer, if they refer people, there's kickbacks all the way up to the original person that did the referral. Okay, that's a business model. But the central bank shouldn't be operating the same way, where they lend money to Wall Street at 0% interest or negative rates, and then Wall Street gets a kickback every time that money enters the economy, and then someone else uses it and maybe lends it out via via the banking system, and it kicks back to the primary dealers, the primary Wall Street banks. So that's no way to run an economy, because you create quintillionaires who then distort everything underneath the economy, and you can create a permanent peasant class like we have in America now.
Well, in this money, the reason why these small businesses are forming is in order to get the PPP funds. Remember the $560 billion that was allocated back in like April or May to go to small businesses. And you could get like millions of dollars that were just handed out. They're not expected to be paid back for the most part. So it's free money. But, you know, this is coming directly from the Treasury. This is coming from the government. This is real money. This isn't like credit money that the Fed just moves all the bad assets off the balance sheets of the banks and put it on their balance sheet. And yeah, in a way, it's monetization, because nobody's ever going to pay that back either. Yeah. So it's a Ponzi all the way down. Whether you look at the credit, you know, the Fed system and the Cantillon effect that they cause, or here in this system, you know, the government, the Treasury and the FBI are arresting some people who have fraudulently claimed this. But it seems like if you look at that chart, like everybody understands it's the cost of doing business. You pay a small fine. Okay, they're arresting some people. Whether
Those aren't real businesses.
No. I'm assuming not.
And just like Apple creates stock market growth without creating any earnings through stock buybacks that used to be illegal. So that's an illegal activity, previously illegal activity. And so the people in the small to medium enterprise businesses are saying, hey, wait a minute, we got to commit some kind of fraud too, or else we're going to get, you know, blown out here. So they create this fraud, and it's fraud or Ponzi schemes all the way down.
Right. And as Bastiat said, is when we have a system that glorifies it. The only way to become rich in America, as we pointed out, is to avoid all taxes. And there are tax loopholes written in the 2,000 pages of tax law in the United States that only a select few, like Donald Trump, get to use. And of course, getting access to making sure that you don't have to take any risk. You've always said this, that they get to defer risk. They take no risk at the top. And now it's trickling down. It's starting to get to the people who could skim $1 million instead of $1 billion off. So the people plundering the PPP system are just plundering $1 million or $2 million, whereas the top at the Fed level, they're plundering by the billions, dumping it onto the balance sheet. But I also wanted to point out, you know, this whole system really started, you were there that day, and the whole moral hazard and the system of plunder set up in 1987. And Monday was the anniversary of that. So happy anniversary on this day in 1987. I remember it well. I've been in the business for 13 months at that point. Dow fell 22% in what is still the worst ever single day performance in 124-year history of the stock markets. Black Monday wiped out an estimated $1.7 trillion from global equity markets. That's when Reagan, of course, came in and formed the Working Group on Financial Markets, otherwise known as the Plunge Protection Team.
Right. So I had already been a stockbroker for 5 years, in 1987. And it was the complete wipeout of all accounts, really. And firms were essentially forced selling clients out of their positions because the firms themselves didn't want to take any risk. So they automatically just wiped everybody out. They just sold everybody out. And they didn't get reports back at what price you sold at for sometimes days. You know, usually you get a report back in a few seconds, but it took days and days. I remember an image of the floor of the New York Stock Exchange, and they still used a lot of paper back then. The paper was actually above people's knees. They were wading through a sea of paper. And so this was, you know, an incredible watershed event because it was caused by the futures market in Chicago and the cash market in New York becoming contentious or broken, essentially. And it went into like a nuclear meltdown, technologically driven, that was out of control. The next day, the market was set to open down another 500 points, and which would have wiped out every bank and insurance company in America. And that's when Reagan, Robert Rubin, and Alan Greenspan stepped in, and they started to buy S&P futures in the open market. It's the first time the government really started to play the market. They created the Plunge Protection Team, which is very active to this day, and we now know it as the Greenspan put. That was invented on October 20th, 1987.
This was the beginning of the cantillionaire moment. This is when they came in to the rescue of bad mistakes that, of course, you can compare it to the Bitcoin market because something similar happened in March via BitMEX when they got into a doom loop of forced selling that caused the Bitcoin prices to crash, I think over 22%. And there was a circuit breaker in that BitMEX, like their back end collapsed. They couldn't deal with all the selling. So it did rescue the price. But here, men came in to intervene. This was the beginning of algo-driven disasters, essentially.
Yeah, it is. Yes, I think that was program trading, as it was called, was just beginning, and that was a major industrial accident, essentially, that caused a meltdown in the financial markets that were completely out of control. But it did now put the government in the position, and they created what became known as the Greenspan put. That is to say, markets can never go down anymore, ever. And we've had that, then the Bernanke put, the Janet Yellen put, and now the Jay Powell put. Jay Powell, unfortunately, will be the last Fed chairman.
But I mean, you see that in the historical charts, is like from this period, stock markets never really go down for too long because everybody counts on, they buy the dip. And it is good, really, in this era to buy the dip because the Fed will always come to the rescue, it appears. And that's created the moral hazard, that's created the cantillionaires. And also like a kind of a snowflake sort of mentality in the markets. Here you guys, I mean, you were at lunch, you said, when most of the fall happened at 22%. You know, today we have, you know, I think the biggest since then might have been a 7% fall in a day. And there's absolute hysteria, total, you know, chaos in all markets when people are panicking and screeching and, you know, yelling like James Cramer did on CNBC, the Fed, this is no time to be an academic. You have to come bail out these markets and blah, blah, blah.
We saw that in 2008. The markets were down, I forget the exact percentage point, but it was maybe 4 or 5%. And the plunge protection team came in, and it was during that bailout period where Timothy Geithner negotiated an $800 billion bailout for his friends on Wall Street, and they crashed the market. They knew that if they crashed the market, they can get the money. They did that predictably, because all the tools to manipulate prices became more sophisticated. For example, now we have the VIX index, the volatility index, which is manipulated, as our friend tells us all the time, the author of Planet Ponzi, Mitch Firestein, you know, he goes in and has done a study on this, how the VIX is used as the tail that wags the dog, because you can manipulate the VIX for a lot less capital, and then that in turn manipulates the entire market. And so it's pure politics, and there's no price discovery.
And speaking of politics, remember, we have interviewed Pippa Malmgren. You should look it up. She was on the plunge protection team under the first George Bush, I believe it was, maybe the second George Bush. But anyway, she worked on the plunge protection team. And she said, you know, people focus too much on the Fed. What they should ask questions is, why does the Treasury have a whole room of trading desks? Like, what are they trading? That should be asked. Obviously, she herself probably couldn't be too explicit about what they were actually doing there because she was part of that team. But it's an important question, you know?
It's American command and control. It's a command and control economy, American style, right? Yeah. We criticize Soviet Union for that, but that's America does it to the extremists.
Well, happy anniversary, Max. Yeah. You survived that day.
Yeah, it was a great day. You know, it was a lot of fun. You know, in your 20s, you know, and everything is fun and everything's a party. So, and there's a great video online of me talking about it to CBS News with Dan Rather. Anyway, we're going to take a break. And when we come back, much more coming your way.
No more yuppie chow.
No. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Stephen Palley. He's a partner at Anderson Kill Law Firm. Stephen, welcome back.
Hey, nice to be here, Max.
It's good to get your overview on things in the crypto space. There's been no shortage of exciting crypto legal news these past few weeks. What's your overall sense of this space in terms of how U.S. regulators and the Department of Justice are treating it or are treating it? You know, we went from a period of no regulations at all to now there are lots going on. What's your feeling of the overall picture here?
Sure. So if you look at you referring to DOJ, which issued a framework last week related to crypto. We've also seen some enforcement activity. We can talk more about it against the cryptocurrency exchange BitMEX by CFTC and DOJ. The IRS issued guidance not long ago. There's some other Treasury guidance on use of crypto to pay ransomware. What we're seeing is that U.S. regulators, and I'm sure elsewhere in the world, but I only really follow the U.S. closely, understand the asset, understand the space, and are continuing to it's almost like a reverse form of regulatory capture, where the regulators are capturing the technology as opposed to vice versa.
Right. What do you mean by that?
Well, what I mean is that if you read some of the guidance and you read some of the views the regulators are taking, they seem to like the technology because in a certain way, blockchain technology allows for really good surveillance. Some wags in the space and conspiracy theorists have actually theorized at various times that Bitcoin was created by U.S. intelligence apparatus. But if you look at the DOJ's recent report, they understand how this works, and it allows them to track drug traffickers. It allows them to track and keep an eye on transfers being made for international terrorist financing. So I think they're coming around to saying that the technology itself is kind of useful from a surveillance standpoint.
Okay, let's take a look at an individual story here. So John McAfee, he's kind of like the Billy the Kid of the crypto space. He was out there in the Wild West, pushing the frontiers, and then the modern times have caught up to him. The long arm of the U.S. law seems to have caught up to him in regards to unpaid taxes and his ICO pump earnings. So what are the overall legal lessons anyone involved in crypto can learn from this case, at least as presented in the indictments?
Well, they always get you for taxes, right? So I saw there are two things that happened. One is McAfee was sued by the SEC for violating a bunch of the securities regulations. He, among other things, allegedly touted particular ICOs, which in the view of the SEC were securities offerings, without disclosing his own holdings, made allegedly misrepresentations about different ICOs. Pretty run-of-the-mill securities law violations, frankly, just at a very high volume. And nothing incredibly new. It's a fairly long, the civil complaint by the SEC is fairly long, but it includes features of many other civil enforcement actions that we've seen in the past. Now, when I saw the SEC complaint, I wasn't yet aware of the criminal indictment, but the first thing that crossed my mind was if there was something, it would probably be taxes, because people who follow the space and follow McAfee know that for some time he's basically been saying on Twitter and social media that he doesn't file tax returns, he doesn't pay taxes, he doesn't have tax liability, and clearly somebody at the IRS noticed, and he was arrested in Spain, and I assume extradition proceedings are ongoing. Interestingly, too, Max, the criminal charges against McAfee were filed under seal, I think in May or June, so they were confidential. They weren't known to the world. They were only unsealed a couple weeks ago when he was after he was seized overseas.
The ICO market, in 2017, there were many of these launched, many situations launched. It seems that in the last year or so, we've had this wave of DeFi tokens. Yeah, and to me, it seems like a repackaging of the ICO. Yeah. The same kind of people, the same hype. I get the same spam. And similar to in Wall Street, it's famous for repackaging the same scams over and over again. Repackaged collateralized mortgage obligation can take 20 different lives in different forms. It's the same scam. Am I correct in saying that DeFi, for the most part, is just a repackaged ICO scam?
Old wine in new bottles, definitely. Technically, perhaps a little bit different than ICOs, but in many respects, yes. What we're seeing are old-fashioned financial instruments packaged in, with fun names like DeFi, but many of them are actually things that are controlled by centralized organizations, by a few people who stand to make money by fleecing the bags of many. So yeah, it's definitely a return of things that we've seen in 2017 and 2015.
Right. And I guess we're kind of going around the table here, looking at all the latest legal developments. Let's take a look at BitMEX for a moment here. The founders and senior executives of BitMEX were indicted on far more serious crimes. What can you tell us about the charges and what are the lessons drawn here?
Sure. So I would say overall, like big picture, if you talk about McAfee, if you talk about BitMEX, the overall lesson is that gravity still exists, and if you get big enough and you blatantly violate, or at least in in the eyes of regulators, you blatantly violate laws, they're going to come and get you. And these things have they have lots of patience, and it can take a lot of time. So BitMEX is a crypto exchange, derivatives futures exchange that's based offshore in the Seychelles, where it moved, where its American founder moved it, according to quote in one of the legal papers, because it would be easier to bribe regulators there. So they were charged civilly, and the exchange, HDR Global, and a bunch of other entities, and several of the co-founders were charged civilly by the CFTC, which is a U.S. executive branch agency tasked with enforcing the requirements of the Commodities Exchange Act. And TLDR, oversimplifying greatly, the things that BitMEX was selling, the CFTC says, were things that required registration as a futures commissions merchant. I believe that's the name, an FCM, under the CEA. And it also required them to comply with the Bank Secrecy Act's AML KYC requirements. Long story short, the CFTC says that there were tens of thousands of U.S. customers, trillions of dollars in trades, billions of dollars in fees from Americans, and they're seeking to claw a significant amount of that money back. This appears to have come at the end of at least a 1.5 year long investigation, which would have been largely confidential. That there were news reports about it last year in July, and apparently at the end of the investigation, they decided to file charges instead of reaching a negotiated settlement, which often happens. Now, the thing about it that is interesting, and I would say allows us to maybe predict a little bit of what's going to happen in the future, is that in parallel to the CFTC charges, just like McAfee was sued by SEC and criminally charged for tax fraud, BitMEX's principals were criminally indicted for violation of the U.S. Bank Secrecy Act. Their CTO was taken into custody in Boston, I believe, was almost immediately released on bond with a relatively, all things considered, relatively light cash collateral, $500,000 cash collateral, and a $5 million bond without a lot of movement restrictions. The last time I checked, the other defendants, including Arthur Hayes, which is BitMEX's CEO, were still at loose. I've heard, I don't know if this is true, but I've heard that Mr. Hayes may be in Singapore, a country with which the United States has an extradition treaty. But they were criminally charged for violation of the Bank Secrecy Act, which requires you to register if you are a money servicing business doing business with U.S. persons. Each violation of the Bank Secrecy Act subject to 5 years in prison and a couple $100,000 fine. If I recall correctly, one of the allegations, either in the CFTC complaint or in the indictment, was that there were 85,000 accounts with the U.S. nexus, which would mean, in theory, and this is not the way it works, of course, but to be a little bit cute, like 500,000 years in prison would be the maximum penalty. I don't think that's going to happen. I suspect that those principals will either turn themselves in or will be located and brought back to the United States.
Right. Let's change gears for a second. Those are the past. That's the Wild West days. And now we've got Michael Saylor at MicroStrategy putting $425 million of Bitcoin on the balance sheet. This is clearly the future direction. You've got a publicly listed company. As a lawyer, and you're in the legal space here, my question is, does this mean that every CEO and CFO and all these companies around the country that have huge cash on their balance sheet, are they almost obligated with a fiduciary responsibility to have a conversation like, look, this guy's going into Bitcoin. We have to look at this now because our shareholders are going to want us to look at it. And he's making a case for Bitcoin versus cash versus gold. And so does this become an item in the boardroom now going forward?
it's a stretch to say it's a breach of anyone's fiduciary obligations to not consider buying, I don't know, onion futures or investing in oil or Bitcoin. I don't think that's the case. What I would say is that what I take away from these prosecutions is not that there's a problem with Bitcoin, right? I remain bullish on the asset going forward. I think what it shows is that it exists, it easily exists in and fits within established laws and regulations. And if you break those laws and regulations, you get in trouble. But that's not BitMEX. That's not Bitcoin's fault. That's the fault of the person who is using it and creating things.
Okay, well, we got to cut it off there. Stephen Palley from Anderson Kill Law Firm. Thanks so much for being on Keiser Report.
It's my pleasure.
All right, and that's going to do it for this edition of Keiser Report with Max and Stacy. I want to thank our guest, Stephen Palley of Anderson Kill Law Firm. If you want to contact, please do. Until next time, bye, y'all.